Ladies, gentlemen, faculty, and distinguished guests, good morning and welcome to Northeastern's third annual Collegiate Alternative Investment Summit. My name is Daniel Sulin and I'm a co-president of CAIS 2015. 3 years ago, our committee had a vision to create New England's first ever student-led conference devoted to private equity, hedge funds, and venture capital. Our goal was to foster an environment where students and industry professionals could come together through their interest and passion for alternative investing. Today, as we get set to kick off our third annual conference, the vision we had 3 years ago has truly become a reality. With students from universities across the country and world-class speakers from esteemed institutions, CAIS 2015 has become the one-stop shop for alternatives. This success, of course, would not have been possible without the help and support of our corporate sponsors, our esteemed speakers, the DeMoore McKim School of Business, and committed students like all of you. We're all here today because we share a common interest for a field which typically doesn't receive much attention in academia. Throughout the course of the day, I encourage everyone to learn as much as they can, not only from the accomplished speakers you'll be hearing from, but from those sitting beside you as well. Take advantage of this excellent opportunity to network with like-minded individuals and help us continue to foster a community devoted to educational enrichment. Now it is with great pleasure that I introduce Dean Hugh Courtney, Dean of the DeMoore McKim School of Business and Professor of International Business and Strategy, to say a few words. Please join me in welcoming Dean Courtney.
Well, thanks, Dan, and thanks, everyone, for that warm welcome. On behalf of my faculty and staff colleagues at the DeMoore McKim School of Business, I am really delighted, thrilled to welcome you here today to our third annual Collegiate Alternative Investment Summit. This is my third as well. I've been really taken by this idea from the start. And I think that you all have made a very wise investment choice on this snowy Saturday morning, dragging yourselves out of bed and getting here, because obviously this is a sector, the financial sector in our global economy, that's increasingly important, complex, high value, and importantly has extraordinary career opportunities open to those willing to pursue them and to educate themselves in this sector. So you've made a wise investment choice, I think, today. One reason that I have always really liked CAIS is that it's quintessentially Northeastern. And by that, what do we do at Northeastern? The students lead. The students lead and operate and make things happen. And I love that about this place. And this is what makes this investment summit special. At most universities, this would all be controlled by faculty and staff. And believe me, the learning wouldn't be as high as it will be today as a result. The energy and passion that you bring in formulating the agenda, in getting the word out, and coming together as a student community is what makes this magic. So I really applaud that. And so I have to thank Dan, thank you for the kind intro, and the entire leadership team for making this happen. That's an extraordinary amount of work. I have to thank Nico, the founder of this, and I remember just telling some folks earlier that probably was no more than my first week or two on campus as dean in the summer of 2012. I just arrived here, and who was on my schedule but Nico pitching this idea, and he pitched it well, as you might anticipate he would have. And so I want to thank him. That said, of course, student-led and operated, but everyone needs a little support, and I'm particularly pleased that Nicole Boyson is here today and will be our first speaker. Nikki's been the faculty advisor from day one. She was in that meeting with Nico to begin with and has provided extraordinary support. And Ben Ware is now here for her second summit and helping to lead with the logistics, and again helps the student team learn about that aspect of the conference. And of course our corporate sponsors who've been very, very generous. Most importantly, I want to thank our speakers here today. They have given their gifts of time and insights are really gifts. They're gifts to you. Take them as gifts as the next generation of alternative investment leaders. and take advantage of their time here with you today. They want you to succeed. They're volunteering their time and insights, so let's make the most of that. With that, I wish you a wonderful day. I was pleased to hear about last night's event and how terrific it was. I apologize right now because I've got to run out and I'm triple booked this morning, but I look forward to hearing about all that you've learned today. Good luck. Thanks.
Okay, well, I guess Dean Courtney had to go, but if he were here, I would say thank you, Dean Courtney, for kicking off our 3rd annual CAIS conference and for helping making this all possible. To start off our speaker series, we have Nicole Boyson, who will be speaking on hedge fund activism. Professor Boyson is an associate professor of finance at the DeMoore McKinn School of Business, where she has been working since 2004. Her teaching interests include investments, fixed income, and alternative investments. Her research interests include shareholder activism, financial contagion, and bank capital structure. She spent 8 years in the industry working in public accounting, banking, and investment advising. Prior to joining Northeastern, Professor Boyson was an assistant professor at the finance department of Purdue University. She's received her PhD at The Ohio State University and has been a CPA since 1992. Please give a warm welcome to Professor Boyson.
Thank you very much. Thanks for having me and thanks for coming to this conference. This is my 3rd year being involved and it's just one of my favorite things that students do, and I love the energy that I get from being around you guys. So this presentation I'm going to do is a little bit of academic research, but also a little bit of history about hedge fund activism. And so I tried to interweave a little bit of the two so that for those of you who know a little bit about activism, there's some technical stuff, and if you don't know anything about activism, well, you'll learn a bit about it. And so I've been interested in hedge funds since the collapse of long-term capital management in 1998. I was a PhD student at the time, and I thought, what a really cool area to do research in. And so 1998 was kind of a long time ago, and I've been working on hedge funds ever since. My current interest is hedge fund activism. And you know, we have this kind of interesting long-standing question about money management. And the big question really is, do managers add any skill? And so you go out, you buy a mutual fund, you pick an active manager, and you're doing it usually based on his past performance. But that doesn't work very well if he can't repeat year after year. And there's lots and lots and lots of evidence that shows that, in fact, most active managers don't. So you get a manager, he has a banner year, next year he's going to probably be average or below. And so it's very difficult to try to invest if you can't rely on past performance. And so as academics and as industry people, we're always really interested in sort of trying to identify that. And we call this performance persistence, or more loosely kind of managerial skill. And we're really kind of trying to focus on, you know, where that skill comes from. And so in this paper, you know, we talk a little bit about hedge funds, and 10 years ago, hedge funds were the big hot topic, and now maybe we worry a little bit that they're not. So my slide says, has the fat lady sung, and what we're trying to demonstrate here is that performance of hedge funds, although hedge funds have grown dramatically, near $3 trillion by the end of last year, performance has declined. And so just so you can take a look, 98 to 2013, hedge funds look pretty good compared to the S&P, but once we start looking forward, 2004, and even the more recent period, hedge funds did okay during the financial crisis, but they didn't do well in 2007, and they haven't done well since. And so you can see they're underperforming. And so why would you spend 20% of profits and 2% of assets to go find a hedge fund manager if you can't even beat the Vanguard 500 index fund, which costs you basically nothing? And so this is a puzzle in money management. Maybe, though, there's a place we can find some outperformance. And so this is just a graph that shows some hedge fund activist performance. The blue line is a graph of 60 of the biggest activists. I'll define activism in 2 seconds. Their performance since 2005. And you can see the blue line is doing better than the S&P 500, which is kind of the orangey line. And HFRI comp is just an aggregate index of overall hedge fund managers. So not activists, they're in there, but everybody else. And they've done terribly. The S&P's done pretty well since the crisis, but activist hedge funds have done fantastic. And so we're interested in sort of why, have they done well? Looks like yes. Why have they done well? So there's kind of an emerging research on this. But what I want to do is take a step back for you and define activism a little bit. And I can flip, I got it. Thank you though. So sort of what is an activist? Well, activism's been around since probably the 1800s. We can trace it back to sort of the early 1900s, and I'll walk you through a little history lesson of hedge fund activism. But generally speaking, if you want a definition, you can sort of loosely define it as an attempt to foster change in target firms. So it doesn't necessarily mean you want to take them over, although that may be part of it, but either through a big block ownership stake, so a hedge fund comes in, buys 5% or more, and then starts jumping up and down and trying to get management to do what he wants. Maybe they write letters, maybe they try to rally other shareholders, but the goal really is to come in as a shareholder and shake up things. Change management, make them do something better. And the ultimate goal of shareholder activism is to increase value for shareholders. Now, we have lots of interesting sort of conversations about, is it long-term value, is it short-term value, are activists just in it for themselves? But certainly the general goal is, I own a bunch of stock in the company, I'll do well if it performs well. So I'm gonna go in and try to make a difference. Oops. Go ahead. So I'm going to give you a little history of activism, complete with pictures of, ugly old men. And so we've got J.P. Morgan here, right? And in the early 1900s, this was fun for me to do a little research, J.P. Morgan, obviously a banker, was involved in a lot of corporate deals. Laws changed after that, and banks weren't as allowed to be as involved, right? So now you don't see banks, JP Morgan, you don't see commercial banks structuring deals from the perspective of trying to get companies to meld together. But one of the very first deals he put together was this Thomas Houston Electric Company and Edison Electric to form GE. And so this was back in 1892. And he also assisted with the merger of US Steel in 1901. And those are just two of many. And so if you think about activism, JP Morgan was obviously a shareholder in both these companies, but he also had access to financing. And so part of his goal as a shareholder, an activist, a banker, was to try to build value by putting companies together. We move ahead a little bit to 1942, and this activism is, to me, one of the most interesting sort of things. So the SEC in 1942 allowed shareholders to put what they called a proposal on a corporate ballot. So I'm a shareholder and I want something. And so what I can do is, if I own even one share of stock, at the time it was one share, now it's a little bit more, but if I own even one share of stock, I'm allowed to go to that company's annual meeting and I get to speak. I also get to put a proposal, shareholder proposal, on the ballot. Now what's interesting about shareholder proposals is they don't work very well. And the main reason is that they're non-binding. So you can put a proposal on the ballot, shareholders can vote on it, they can sort of overwhelmingly support that proposal, but the company doesn't have to do anything. And so they don't have a lot of teeth, but the idea of it is that at least shareholders are having some voice, right? And so this is interesting. And so this case, I think, is kind of cool and sort of speaks to sort of American history, but activism was dominated by individuals in sort of the 40s to, say, the 70s. And this story I kind of like. So this guy, James Peck, was what was called a freedom rider. Maybe you guys know what freedom riders are. I didn't. So, in the early 50s, late 40s, early 50s, there was a big civil rights movement kind of budding in the US. And James Peck, there were some regulations passed that said, on buses, people have to sit wherever they want to sit. So you can't segregate buses based on race, gender, whatever. And so it was interesting because, of course, the bus drivers weren't supposed to enforce this, right? So you got a bunch of angry white guys, and then you have a bunch of people who are trying to find some sort of civil justice, and there were lots and lots of bad things happening. So there was a group of men that was formed in around 1947, this guy James Peck, and it was something like 7 Caucasian guys, 7 or 8 African American guys, it's all guys at the time, and they would go around, they would get on buses, and they would try to make the bus drivers enforce the civil rights, which were no segregation, you get to sit where you want. Well, as you see, James Peck got the crap kicked out of him on a frequent basis, right? So James Peck, victim of an attempt of lynching, and it was awful. It was an awful time in U.S. history, but it was part of the U.S. civil rights movement. And so what James Peck did was he bought 1 share of Greyhound, and he got to go to the annual meeting and talk. And so again, this is another case of shareholder activism that doesn't have a lot to do with stock performance, but it certainly has a lot to do with shareholder voice. He didn't have much success, but laws were later passed and enforced that worked a little bit better. In the 70s, there were a lot of activism campaigns that were related to sort of, again, social issues. And at this point, Dow Chemical was producing and selling napalm, which, as we know, is a terribly dangerous chemical. And there were a bunch of doctors that got together. The Medical Committee for Human Rights got together, and they worked to try to get Dow to stop selling napalm. They put a shareholder proposal on the ballot. It passed. Shareholders said, yes, you should not sell napalm. It took a couple years, though, for Dow to actually implement that. But what was interesting was this opened some doors. There were some lawsuits filed, and this opened some doors that allowed shareholder proposals to have a little bit more impact, a little bit more bite. So that's kind of a historical perspective on activism. And then the 1980s come along, and all these guys, right? You got Carl Icahn with his Grecian formula. You got Nelson Peltz, who's terrifying. Kurt Kerkorian, who's kind of handsome, and then a bunch of other guys, and they were coming around, and they were corporate raiders, right? And their job was to go in, and they tried to get companies to, be sold. So sometimes they would finance the sale, sometimes they would arrange mergers, but this is the hostile takeover era. And so if you're a corporate finance person, it's an interesting time in the history of corporate finance, because what you see is that shareholders typically have two choices, right? If you own the stock, and you like the company, you hold on to it, you buy more. If you don't, you sell, right? They call it the Wall Street walk, voting with your feet. This, though, the shareholder activism gives kind of a third way for shareholders to potentially make a difference. And these corporate raiders were coming in and trying to do that. And all kinds of interesting stories about them, and lots of them. But good old Carl Icahn up there, as a much younger man, was a corporate raider. And they were, you could call them vulture investors. These guys did not get a good rap. But I would argue as a corporate finance scholar that they made a difference. And there were lots of companies that were poorly run, that had lousy management, and these guys came in, not always doing it well, but many, many times making a difference that was valuable. And so that's kind of the 1980s activism. Lots of anti-takeover laws came in, and it became much harder to go in and buy up a company. There were repeals of anti-takeover amendments, there were greater board independence, cumulative voting, etc. And so, sorry, getting ahead of myself, a bunch of laws were put in that made it harder to be taken over. And then, sort of late 1980s, some pension funds came in and they said, we don't like these laws, they're ridiculous, let's fight to try to make shareholder rights a little bit better. And these were some of the things that happened. Repeals of anti-takeover amendments, cumulative voting, greater board independence, etc. So this is kind of what was happening. So first you've got JP Morgan, then you've got a bunch of individuals trying to do activism without much success. You have a bunch of corporate raiders that basically torch the world. You have the lawsuit, you have the courts come in and they say, sorry guys, this corporate raider stuff is not good. And then you have some pushback from pension funds and others. So CalPERS, CalSTRS, big, huge pension funds in the US. So what happened was, in the early 1990s, activism kind of shifted. And it was a little bit of a subtle shift. There's still some corporate takeover stuff happening. There's still lots of individuals. But now what happens? A whole bunch of hedge fund managers jump in. Now, hedge funds have been around since the late 40s, but they haven't been doing this kind of activist behavior really since, say, the early 90s. I mean, you might call Carl Icahn an originator, and he's in here again, right? Looking older, probably holding a martini in his other hand. But then you get a bunch of, young guys. You got Bill Ackman up here. You got Dan Loeb, Jeff Ubben, the guy up top, and then a couple other guys, Nelson Peltz and some others. And what these guys did is they came in and they said, look, we're hedge funds. We own stock. And instead of kind of the classic hedge fund strategy, which is, buying long and going short and trying to make money on arbitrage, hedge fund activists are actually typically long only, right? Meaning they buy stock and they hold on to it and they try to go in and do stuff in the companies in which they invest. And so you have this wave of, I would argue better looking and younger hedge fund activists that are coming in to try to make a difference. And so what are they doing and how are they doing it? And so sort of starting in the late 1990s, hedge funds became the predominant activist. And what we found as academics and also as industry, people and practitioners, and you read the news, activism seems to be working. Not without controversy, and I'll talk a bit about that, but it does seem to be working if you look at large data sets and lots of data and take out sort of the, the outlier events where something really great happened, something really terrible happened. We look at sort of on average, it seems that hedge fund activism appears to be making a difference. And so how are they different? This is the subject of some of my research by others. Lots of industry people are interested in activism. I think last night, Sam Clark, one of our speakers, talked about activists coming into firms in merger settings. And so people, and he's not a hedge fund activist at all. I mean, he runs a merger arbitrage fund, but he's aware of activism and he's aware of how it affects the space in which he invests. And so they do a lot of different things. Sure, they do shareholder proposals, but they also will directly negotiate with companies. They'll get involved with the media. I mean, Carl Icahn tweets, right, all day long about what he's up to. Proxy contest. Proxy contest is when you go in and you try to replace members of the board of directors. So you've got a board of directors, they come up for voting every year. A proxy contest is when a hedge fund or another activist comes in and proposes an alternative slate of directors. And they have what's called a proxy fight, and it gets really nasty and expensive, but it's one way to come in and really change a company. If you can replace the entire board of directors, you have a lot of power. Litigation, outright takeovers occasionally, although that's less common for hedge funds. More often what hedge funds will do is what we call putting firms into play. So they'll go into a company and say, hey company, you have lousy management and you're undervalued. You should sell yourself. And about, a good chunk of the time, it actually happens. And then sort of relational investing. Interesting stuff. So here are some quotes. So Dan Loeb is one of the famous hedge fund activists. His picture was up there. And he's famous for these letters that he writes. So you can search him online and find some really hilarious quotes. So I'll just read you some of them. So Dan Loeb's writing to Ligand Pharmaceuticals. He says, I wonder how in this day of age the board of directors hasn't held you accountable and shown you both the door long ago, accompanied by a well-worn boot planted in the backside. And that's one of his more polite letters. He also wrote to Star Gas. This one makes me laugh. I was amused to learn in the course of our investigation that at Cornell University there is an ERIC 7 scholarship, CEO. One can only pity the poor student who suffers the indignity of attaching your name to his academic record. And that's just great stuff right there. And then Bill Ackman, this is an interesting case. So Bill Ackman's Pershing Square. He usually is long. He's usually buying stocks and trying to get changes. But he's got a very famous, if you read the news ever, you know this, he's got a very famous short right now on Herbalife, right? He's short selling the stock, which means that he borrows it, immediately sells it, and hope the price tanks. And he's, he's creating this. He's usually not so excitable, but this case is, he hates Herbalife, apparently. And so he argues, Herbalife, the customers are fictitious, the business opportunity is a scam, the university degree is a fraud. And he puts together these, 75-page PowerPoint documents and just is always posting them online. And so some of this is rhetoric, certainly, right? But these are two pretty famous activists who actually have very, very nice track records in performance. And so when they come into your firm and start jumping up and down, you're probably going to take notice. Just some stylized facts about activism, some really recent stuff that's been happening. So if you look at activist hedge funds as a category, right, there's tons of different styles of hedge funds, fixed income arbitrage, long short, blah, blah, blah. If you look at them as a strategy, the flows going to hedge funds that are activist-based have made up 20% of all flows in 2014. So people are interested and people are putting money in the hedge fund activism space. Makes sense, right? Their performance has been good, other hedge funds have been kind of lousy. 28 new activist-focused funds launched in 2013. That's a lot. 344 separate campaigns to different target firms that they're trying to change. 1 in 2 S&P firms has an activist shareholder in existence, and 1 in 7 have actually been targeted by a campaign. So you can own stock and not be an activist, right? You can be Bill Ackman from Pershing Square, hold 3 or 4 or 5% of a company's stock and be a passive holder. But if you're sitting there and you own that company's stock and the company knows you, there's potential for activism. We can't observe all the activism that happens, right? Phone calls and letters and so forth. So what we're interested as academics and practitioners and people who are investing is, does activism work? This is a graph from a paper that was published a few years ago, but what they're looking at is the black line is stock performance around the announcement. So when a hedge fund starts an activism campaign, there are lots of ways they can announce it, but one very regulatory and kind of legal way they announce it is they have to make a filing with the SEC. So the SEC requires that if you buy 5% or more of a company's stock and you have any intention to do anything activisty, you have to file a 13D form. And so what we do, this is not my paper, but everyone who studies activism looks at this. What we do is we look at the stock performance, the stock price reaction to that filing, right? So the hedge fund files the form, 13D filing, and then we look at the stock price reaction around it. And so the filing's right there, and the black line is representing the stock price performance. So if you go back 20 days and out 20 days, so minus 20 days before, plus 20 days after, you get about a 7% bump in the stock price. You can also see that the volume, which is the bar graph, is increasing as well. So in other words, the hedge fund's buying stock, sure, that's fine, that's going to cause some volume, but investors take notice of this. So when Carl Icahn files a 13D, I can promise you there are a whole bunch of other institutions, individuals who jump in on that stock, which drives the price up. And so a short-term stock price reaction is interesting, but it's not telling us the whole story, right? It could be that it comes back down, it could be that it's temporary, it could be that it doesn't mean anything. So what we also look at, and this is not, again, exactly my own work, this is a combination of a bunch of people who've done work in this field, is that one thing that makes hedge funds different from other old school activists is they actually get what they ask for. And about half the time, they get what they ask for. And so these are some of the categories that we can sort of divide their activism into. Wanting board representation, 62% of the time. This actually is my own data. Takeover related activism, they come in and say, you sell yourself or we want to buy you. 45% of the time that happens. Governance related, you need to get rid of your anti-takeover devices. Your board is entrenched. You need a more independent board. Your board's too big, your board's too small. About 40% of the time they get some response from the firm that's positive on that. Capital structure related, this is the most popular thing you've seen lately. You need to pay a dividend. You need to buy back stock. About, 42% of the time that's happening. Management related, you need to fire the CEO. You need to fire the CFO. You need to do something. They're not as responsive to that, but about 30% of the time that seems to happen. Sell assets or do a spin-off, close to 50%. The other's interesting. So hedge funds will often come in and say, listen, you just announced a merger. The price is too low. We need to improve that. And hedge funds will often come in, and what they'll do, if they think the merger price is too low, they'll get other shareholders to vote against the merger. And many, many times the merger doesn't go through. Or what they'll do is they'll go out shopping and try to find a third party who's going to bid more. So you see very often this happens. There's maybe, 150 of these in my sample out of 3,000 events. So it's not a huge amount, but they have a fair amount of success at that, right? 50% of the time they either block the merger or get a higher price. And then all categories put together about 50%. This is vastly different from any other activism that's ever been done. You've got pension funds, you've got individuals, and they try, but they just don't seem to have the clout or the power or the big loud voices that the hedge fund managers seem to have. And so again, we saw this short-term bump. We also see this sort of success in what they're trying to do. And there's also some evidence that operating performance improves. And operating performance is really the hard one, right? You can see a stock price bump, but to find operating performance improvement, that's a big deal. And we find some evidence of that. Look at cash flows over assets, ROA, whatever. There's also a lower probability of these firms delisting or failing. And so you can think about an activist. Three things can happen, right? The firm can get acquired. That's a hugely good outcome typically, right? You get this nice bump. The firm can fail, terrible outcome, or the firm can continue as a viable entity, and then you can look at that performance. And so again, in all these cases, we have lower probability of failure, higher probability of takeover, and up to 3 years out, better operating performance. There's some recent work, you might just go back for one second. There's a little bit of recent work that shows some plant level operating performance improvements as well. I don't know if I buy that, but there's some smart guys doing research that say that's happening. Why don't we flip ahead a few slides? So my current story, what we're trying to look at is activism persistent? And so what all these sort of stories I've told you so far have said, activists come in and they do good stuff and they seem to get results. My current project that I'm working on is saying, okay, that's super interesting, but where does that come from? Is it the same activists over and over again that are getting this good results, or is it just anybody? So if Nicole Boyson goes in and buys 5% of a company's stock, am I going to have the same success as Carl Icahn or Bill Ackman or Dan Lowe? The logical and intuitive answer should be no. And that's kind of what we're investigating. So as an activist, do you develop skill over time? Do you have persistence in your performance? And kind of where does that come from? And so just a few quick slides I'll kind of quickly go through. If you look at the sample, we have like 3,000 events or something. Go back just one slide. There. Yeah. You can see the big guys that are doing activism, all the guys I mentioned before. But what's interesting is the top 10 activists in the activism space conduct over 20% of the activism. So out of, I don't know, 550 activists, 10 guys are doing 20% of it. There's a lot of concentration among the guys that do it a lot. So that's some evidence that either they're crazy and stupid and they just keep throwing good money after bad, or they're doing something. They're actually making money doing this. Now, when we flip ahead a few slides, I'll just show you a couple of our results. So what we're interested in, let's leave it here. So what we're interested in is that as a hedge fund manager, I go in, I do activism, and I'm very interested in trying to improve the target firms. But there are a lot of other guys coming in, other hedge funds coming in, and also trying to compete in this space, right? So as competition increases, we know that returns ought to erode, right? That's just sort of finance math. But what we find that's interesting with our experienced managers is a couple interesting key points, and then I'll wrap up and ask for questions. One thing we find is that as hedge funds gain experience, they target new industries. So they branch out from kind of their comfort zone and target new industries. Probably the most important finding of our current paper is this one. And we find that as hedge funds gain experience, they actually become more aggressive in their activism. So take a second and think about this. If I'm Carl Icahn, and I know that when I buy 5% of a company's stock, I'm going to get a 6 or 7% bump in the stock price, it's probably in my best interest, if I'm not actually a very good activist, I just have a good reputation, to not do very much, right? So you would imagine that maybe Carl Icahn came in and had really strong results for his first 5 or 10 activism cases. And he actually did stuff, right? He made changes and the performance got better. After that, though, you imagine he could just rest on his laurels, right? He could just come in. He knows that the market likes him. They're going to give him this stock price bump. And so he could just come in and stop doing activism. He just pretends he's doing it, right? Buys a bunch of stocks, stock price goes up, and then he quietly gets out. But what we actually find is that's not what's happening. Instead of doing that, these frequent, powerful activists are actually coming in and doing more aggressive activism, which means that they must be getting some value from that. It's not just this short-term stock price bump. It seems to be something more. And so they're going in and doing more of this. And why don't we just flip ahead? We can just go to the conclusion. We'll ask a few questions. Let's see. So we'll conclude. I'll do the final. We'll go to, I think there's 3 concluding slides. There we go. And so the final thing that we do, so we kind of show that activists have persistence in performance. We show that they seem to adapt over time by becoming actually more aggressive in activism. And even as they become more aggressive, they actually end up having greater success rates. And so what happens, Carl Icahn goes in, he has some success. A few campaigns later, he goes in again. He's even more aggressive than he was before. An interesting thing we find is the target firms fight back harder against the Carl Icahns, the Bill Ackmans of the world. But despite the target firms fighting back by worsening their governance or making it tougher for activists to do their job, the activists actually have better success. And so we think that we're telling kind of a neat story, not only that activism seems to work, but sort of the mechanism by which it works. And so I'll conclude with that, and we've got a good 5, 6, 7 minutes for questions. Please feel free to ask any questions you would like. Oh, sure. I don't know if they want to get you a microphone. I'm sorry, did you have somebody and I picked somebody else? Okay, perfect. Oh, go ahead. Do you mind raising your hand?
Sure. Check. So my question is, are there any sort of mainstream publications that sort of deal with these stories of activist shareholders? I mean, in the 80s you had Barbarians at the Gate, which became a national bestseller. Is there any sort of book similar like that that sort of exposes it, or is it sort of still below the mainstream?
It's interesting. I don't know if there's any kind of popular press books. There are a couple more academic-y books, but they're not very good. I've read them and they're really boring. And so there's not, but there are tons and tons of websites. And another place you might look, there's there's actually a mutual fund called the 13D Activist Fund that tracks activist stuff. And if you go to their materials, just find them online. I forget what their ticker is. You can just find them on Morningstar and read some of their materials. They'll reference some of the literature that's interesting. So yeah, but it's kind of a neat phenomenon that's happening, I think. Other questions? Keith? I'll just keep talking if you don't ask questions. I'm kidding.
So typically we see activism come from the long side,
Mm-hmm.
right? But Bill Ackman's turned that around and now he's an activist on the short side.
Right.
Right, and now he's getting an SEC investigation for manipulating the stock price because he's trying to talk to the FTC for getting Herbalife into a fraud place, right?
Yes.
So where do you draw the line between insider trading and stock manipulation and actually trying to help the company and help the shareholders?
You know, it's a super good question, and it's interesting because I don't know, you know, hedge funds don't have to report their shorts. And so when you follow 13D, if you're short 5%, you don't have to report it. And so what we don't know is how frequent this is, right? We don't know how prevalent it is that the Bill Ackmans of the world are doing this. Now, it only seems to make sense that you would publicize it if you're doing it, if the whole point is to kind of drive the stock price down. And I find this to be a really interesting case because most of his activism is on the long side, right? He's got tons and tons and tons of experience doing activism in sort of a long-only kind of way. And this is the one case that we see on the short. And so my gut would say that it's less likely that hedge funds are going to do this, particularly in light of what Bill Ackman's up to. And it's difficult to sort of understand why he's pushing so hard on this, given his reputation, given his wealth, given everything that he's doing. But I also think that egos are pretty large in this space, and it could be just that he doesn't want to be seen as being wrong. So, but I don't see, my gut says I don't see a lot of this. Insider trading is a tricky one. I mean, if you're an activist and you're involved with the company, you're talking to management on a regular basis. Insider trading is really hard to see, prove, and enforce. But since they're disclosing their interests, I think the regular kind of run-of-the-mill activism is probably not crossing that line. But I think this short stuff is just, kind of questionable and potentially shady. So it's the old sort of pump and dump scheme or whatever, right? So yeah.
So say I'm trying to open up my IRA account or something like that. Would you still recommend that I go to a money manager or just put all my money in kind of an index fund? Because, as you said, money managers aren't always giving back these same returns, and they're often not underperforming compared to the market.
Yeah, that's a really good question and less about activism, and I like the question a lot. Personally, my gut says index, So I personally, my large cap allocation, I can't find a money manager that can beat the S&P 500 consistently. I think in the international and small cap and mid cap space and maybe in some of the bond space, there are some reasonably good active managers that are accessible to, normal people, so through mutual funds, but I think they're hard to find. So, especially as time passes. So, a big reason is expenses, right? It costs, say you're running just a run-of-the-mill small cap mutual fund, probably costs you 1.5% a year. Costs an index fund, 10 basis points. And so over time, even if you are beating the market, you've got to beat the market by 1.5% to be even. And so one of the big problems with active management is not that managers are paid, you need to pay them, but that their salaries effectively take away any outperformance that they're giving you, resulting in very difficult ability to outperform the market. I still think there are some gems out there, but it's I don't know how you pick them. I probably wouldn't be a professor if I did, right? So. Hi.
Hey, thanks. That was great.
Thanks.
This is the first year where net inflows to ETFs were equal to that of mutual funds, right?
Yeah.
And what's really interesting is this sort of landscape that's shifting away from active management. And we haven't seen the eclipse happen in 401ks yet, right?
Right.
Where do you see the next 10, 15, 20 years in terms of active versus passive management? Because you've obviously researched it a lot.
Yeah, no, I think it's really interesting. We're not talking about activism now per se. I still think, there's some light here in the activism space. But just in general, active management versus passive. ETFs, exchange traded funds, are kind of like mutual funds, but they're cheaper and they trade more frequently. So if I buy an S&P 500 ETF, it prices all day long mimicking the S&P 500. If I buy the S&P 500 mutual fund, it prices once a day. So ETFs provide more liquidity than mutual funds. They provide some advantages, potentially tax advantages, et cetera, et cetera. So that's just my 2-second education on ETFs. But you're right, what we're seeing is a big shift in, and it's a lot of the sort of vanguards of the world, right? Jack Bogle's been jumping up and down screaming for like 50 years that index funds are the way to go, and people are starting to listen. So I think there's two things. I mean, one is that I do think there's going to be kind of a general shift out of mutual funds to some extent and into ETFs just because of their structure. I still think there's space for sort of the mutual funds, but more interestingly in this passive versus active debate is that there's this middle ground of, well, you're not an active manager in that you're not going out and trying to pick stocks, looking for value, like our student value fund does, for example. But you're not also just an indexer where you say, I'm going to mimic this S&P 500 exactly. There are these sort of ETFs out there, lots of them, that they call smart beta. And if you know what beta is just kind of your correlation with the market, right? So if you buy an S&P 500 fund and it mimics it exactly, your beta's 1. And that's fine. But what do these smart beta funds try to do is take advantage of some of the industry and academic research that says, hey, there are certain things, and if you take my investments class, you know this, right? There are certain things in the world that just seem to happen. Small companies do better than big companies. Value stocks do better than growth stocks. There's this momentum effect. There's this liquidity effect. And so what these smart beta funds do is they're not picking stocks, but they're picking sort of strategies. So they're saying, hey, you know what? If small cap stocks outperform large cap stocks, I'm going to overweight small cap stocks. And if value beats growth, I'm going to overweight value. But they're very systematic in the way they pick them. So just like I tell my students, my cat could run an index fund, right? He's very smart. But he could also run a smart beta fund if he had a couple smart PhDs behind it doing the programming. So it's not like my cat has to go pick stocks. He just has to push a button or whatever, I don't know if it's paw, push the button to sort of start the strategy. And the neat thing about the smart beta stuff is it's super cheap to run, so you have low costs just like you do with a passive, S&P 500 fund. But you're also using some smart stuff that smart people have discovered to try to outperform, say, the S&P, outperform, say, a passive index. So my opinion, again, for what it's worth, is that I think you'll see a lot more, fuzziness between passive and active because you've got this kind of smart beta stuff in between. As academics, we love that because we're the ones who discovered a lot of this stuff and we like having our work validated by normal people, not just other academics. But I do think the smart beta stuff's really interesting. So that's my gut. But I do see a shift definitely from active to passive. And if you're running a mutual fund and you're an active manager, you're going to be held a lot more accountable than you were 10 years ago, say. So
that's all we have for now. Questions? So thank you, Professor Boyson.
Sure.